I have mentioned it before and I will say it again. Asset allocation is an investor's most important decision. Your asset allocation determines your portfolio's performance, risk, and volatility. Welcome back to my channel. My name is Reese, and in today's video, I am discussing what your asset allocation should potentially look like and why. There are two rules that Warren Buffett lives by. Number one is to never lose money, and number two is to never forget rule number one. Seems simple enough, right? This is fantastic advice in the world of investing, but also useless as a utility because it doesn't really give you anything to work with. The question, what should I invest in, is a tough one because there are so many different categories that you could choose from, such as residential property, shares, bonds, cryptocurrency, commercial property, cash, just to name a few. How do you know which ones to put your hard-earned cash into? The question is also known as asset allocation. It is how you divvy up your money to diversify into different asset classes. The video that I made about what different types of asset classes there are is linked down in the description below. That is kind of a prequel video to this one. So definitely go check that out after this one if you're unaware of what types of asset classes there are. And while you're down there, don't forget to like and subscribe. It really helps the channel grow. Now, the answer to this question differs based on your age. However, there is a methodical approach that you can take to put you in the best possible position to achieve your future goals. There are two identified main methods of asset allocation, and they are known as strategical and tactical. Let's start with what a strategic asset allocation is. It is based on two things. It is based on how long you have until you are going to retire and what the investor's risk profile is. This type of approach is based off of long-term historical returns and volatility. As an example, if you were to follow this method and you were someone who was very risk adverse, you would probably take the majority of your money and put it into defensive assets, such as cash and bonds, things that return very slow or low returns over long periods of time. So it builds wealth over time, but in a relatively safe manner. And I'm talking about like decades here. Whereas a tactical asset allocation is where an investor will basically play the short game. They will actively invest into markets and investments that they think will bring them large returns in shorter periods of time. In my opinion, this is an incredibly risky way to structure your investments, but it is an incredibly popular method that people do every single day. Technically, and if I'm being completely transparent here, including myself. An example is that I saw the potential of a cryptocurrency known as VeChain. Definitely check out my videos that I've made on them if you're interested. They're some of my most popular videos. I took a punt on VeChain and I kind of won the lottery. I made a significant return, but that is what I would definitely call a tactical asset allocation. I put money into an asset class that is very volatile and very unpredictable, and it paid off in my instance. So just keep that in mind for later in this video when I start to talk about the structure of how you should structure your asset allocation between the two, both being tactical and strategical asset allocation. Okay, so with those two methods covered and me going through an example of what you might expect someone who's following those methods to do, or how it would be structured based on the type of asset class that they invest into, this is going to be, in my opinion, the best way to structure your asset allocation, or the best method to follow. And it's, like I said, my opinion. It's not financial advice. This is how I believe I'm going to build wealth over the next 3 decades of my life, and how I'm going to build it in a way that secures my money, but also gives me the opportunity to take opportunities that might pay off in the long run. I believe a mix between both strategical and tactical is the way to go. But I would definitely be leaning much heavier towards the strategical method. I have seen many people successfully build wealth over time using the strategical method in many different ways. The best and strongest example for those living in Australia, but those outside of Australia would definitely be able to relate. In America, it's a 401k. In Australia, it's called superannuation. It was literally designed to drip feed money into investments over the course of a career. The whole concept is that every time you get paid in Australia, they pay you 9.5% of your wage into not 9.5% total, 9.5. Oh yeah, it is. It's 9.5% of what you get paid every week. Wow. I love superannuation. I love the concept of it. It's brilliant. Check it out if you're interested. I've made a video on it as well. But the whole concept here is that they pay you 9.5% of what you get paid each fortnight, each week, each month, whatever it is, into the share market. They basically invest your money, and it's kind of locked down. I can't access that money until I retire. So we have a number of decades of a career where my money is being invested. That is the prime example of the strategic method of asset allocation. That's just one example of how I'm personally investing strategically. I'm also investing into shares passively every year. I invest into ETFs very slowly. I invest a specific amount of money each year into them. At the moment, it's around $5,000 to $6,000, which might not seem like a lot, but over the course of 30 years, I'm 26 at the time of recording this video. By the time I hit 60, that's going to be a lot of money that has been passively or strategically invested, and that will make up part of my asset allocation. Then from here, moving forward, I also throw in some tactical investments, definitely much smaller portions of my total asset allocation. I'm invested into real estate, I'm invested into the share market, I'm invested into cryptocurrency. That would be a tactical one where I've kind of drip fed a little bit of my money into it with the hope that it absolutely goes crazy. And like I mentioned earlier, it kind of has with one of my investments, but the potential is there for a lot of the other investments that I'm making. So just keep that in mind. I definitely have it split up between strategical and tactical, definitely leaning much heavier towards strategical. Just as a fun fact, based on historical returns, investing money into cash, bonds, and property are generally your safest bets when it comes to investing your money. And the more riskier ones are things like the share market and cryptocurrency. It's kind of obvious if you didn't already know, but worth mentioning nonetheless. In Australia in particular, I've noticed that most young people are investing into residential property. In Australia, it's all about real estate. Get yourself a property that you can live in, or an investment that you can live at home with your parents, rent it out, make some money, and then move into it in time. I myself have fallen into this category. However, it's definitely worth understanding, and it's great that you've watched this video all the way through, because hopefully it started to make you think that, hey, some of my money should potentially be going elsewhere to have a more diversified portfolio. Not saying that it is the answer, but it's definitely something to consider, and it's something that I, at such a young age, I'm 26, like my career is really only just starting. I finished uni maybe 5 or 6 years ago. I'm really starting to see the benefits already from investing into things like the share market, just as an example. I'm putting portions of my disposable income into these asset classes through my asset allocation, and it's starting to pay off already. Think about what another 40 years could definitely do for me. I also want to be really clear here as well that there is no definitive percentage breakdown of how you should structure your asset allocation. It's more, you should diversify your money so that during a boom, you don't miss out, and during a crash, you don't lose everything. Keep that in mind as well. I want to wrap up today's video by saying achieving a perfectly balanced asset allocation year on year on year, or year over year is technically impossible. You will have good years, you will have bad years. It depends on how you make your investments and diversify into different asset classes that will allow you to build wealth safely, consistently over time. The key thing to think about here is to invest into quality assets. There are good cryptocurrencies to invest in. There is good property to buy. There are bad cryptocurrencies to invest in. There is bad property to buy. Keep that in mind as well. It's important to understand. And with that being said, I'll leave you there. I hope you enjoyed today's video. I hope that it was insightful. If you did enjoy it, please don't forget to like and subscribe down below. It really does help the channel grow. And as always, I will see you in the next one.